and in this video I'm gonna tell you way more about down payment by itself. In the previous one I spoke in a very general way about the main rules, and right now we're going to, let me just write it down, down payment. And we're going through 4 the most important points. Regulations on the market, pros and cons, 10 or 20% versus 20%, refinancing to other bank, and the offers, like if I go with only 10%, if it's gonna be way more expensive, what's gonna be the differences? So, first of all, we have institution called KNF. It's a financial supervision committee. It's an institution, as I said before in the previous video, related to the government. They protect you, they care about your wallet, your goods, and they kind of supervising the banks in order to not make offers that they're gonna be harming you. So they say also something about the risk, that they do recommend that LTV, what you remember, it should be lower or equal 80%, because of the risk. If you have 20% of own contribution, all down payment to the investment, the risk that something go wrong, the real estate market price is gonna drop a bit, or you're gonna have a problem with payments, or you're gonna stop to pay because you change your mind and you just wanna drop the keys from the house, it's way lower for the bank because you are still having their 20% of your own contribution. So on the one hand, it's protecting you from the market, like, as I said, dropping of the price or something very unpredictable. And on the second hand, it's kind of guaranteeing bank that the risk is lower, because if you put 20% instead 10%, they kind of can make assumption that you don't want to really lose the real estate, so you're gonna pay and you're not gonna make any delays. So that's the regulation, but only as a recommendation. There is still, I would say, half of the banks, or let me write it down, like 90 versus 80, so 10% versus 20% of down payment. There is still, I would say, half currently of the banks on the market which gonna really agree on giving you the mortgage on 10%. What is 10%? It means that LTV is gonna be 90%, right? So I don't want to really put the names of them because they are like still very dynamically changing. They're rotating in the how to say it, the rankings, right, of the banks. So no names of the particular banks, but in generally speaking, they have a significant difference between offers on 10 and 20%. What is obvious that when you have banks with 10%, they still existing on 20% wallet. Let's say this is like 2 buckets, 2 wallets. So they're gonna give you the mortgage with better conditions in the same bank if you have 20% plus, because let's say that there is no much difference if you have 20 plus 20, 30, 40. Let's say in general speaking that there is so much difference. So if you go on 10%, you have access only to, let's say, half of 20 something banks right now on the market. In reality, the good ones of them, I would say, is gonna be 4 or 5 maximum to consider. They're gonna be really worth to consider. And with 20%, you have access to full offers on the market. What's the first difference? They're gonna force you to take, it's called insurance of own low own contribution. What does it mean? If 20% is recommended, they're gonna give you on 10, but they're gonna say, all right, so we have a way higher risk because we kind of breaking the recommendation and our risk is really, really high, then we want to put on you insurance. You as a client gonna pay for that from the low on contribution until you gonna have 20%. I'm gonna explain you very shortly how you can get to this point with having LTV on 80 very soon when you start to pay. Or sometimes instead the policy, the the insurance policy, they're gonna just give you the way higher interest rate, the margin of the bank. So A or B, but it's gonna be really a significant difference on the monthly installments. Then let's draw the timeline. Just for instance, you're taking the mortgage for 30 years. Then first 5 years, it's gonna be about almost, let's say your installment, it's flat. It's not a fixed one, but it's not decreasing. It's just like constant, right? It's a different video about the types of installments, but let's say that you paying interest like exponentially, kind of like that's the capital, that's the interest part. So at the very beginning of this 30 years, you're gonna pay, let's say like 10%. It's approx 10% of the capital left. You're not overpaying earlier. You are just paying normally the installments day by day from the schedule. So we can kind of estimate from the schedule that in the first 5 years, you're gonna pay off 10% of the capital you took from the bank at the very beginning. So what does it mean? That your LTV probably is gonna drop to 80%, but it's even easier. Let's say we have in inflation tax. So it's about money losing their value in the time. I don't want to bring up right now the percentage because the video is gonna be like for long months or even years on the internet. So again, generally speaking, let's say just for instance that the inflation tax is right now the real one, not CPI, but the real one is 7%. So if the real estate wouldn't rise up this annually year by year 7%, it would mean that the real estate by itself, the house or apartment you bought, it doesn't matter, primary or secondary market, would actually lose the value according to the money in your pocket, right? To the value of the money by itself on the market. So kind of they should rise at least the 7% to just be on zero year by year with the value of the money around, right? In the same country. So that's the first thing. But currently the real estate is growing even more. That's the very deep conversation about the savings, about moving deposits, there's still huge demand on the market and not enough of fresh investments. But making the long story short, if you're buying the primary market from developer, there is a high chance that the second, the third, the fourth episode of the same investment is gonna be a little bit more expensive. Why it's so? Because if you're buying the ground, the hole in the ground, you're just like buying nothing, right? They starting construction. It's usually cheaper than the already done finished investment. So it's very common that when you are looking for the first, for example, episode of the particular investment in a city, then you are already living there. After 2 or 3 years, they're constructing more and more. The whole district is developing. There is a new railway. There is new quick tram. There is a lot of new stores, restaurants, everything. Like the whole urbanic area is like urbanically rising up. You know, it's more and more stylish. People want to leave the room to move there. Then the value of the whole district is a bit rising up. Sometimes it's even doubling. Sometimes just like few percent, but still. Right now, we can, in this example, say that it's going to be a few percent more than the inflation. So then, how it is? Let's say that you bought for, I need more space here, okay. Your LTV was 900K. You just paid 900K, let's say that's a secondary market, there is no finishing, no renovation, just 900K. And you had only 10% of down payment, so it would be 810 on the nominator divided per denominator, it's gonna give us 90%. But if the denominator is gonna in the future rise up, let's say to 1 million for easy math. I'm not saying in like 1 month or it's gonna happen in 5 years, no matter, for this example, you're gonna pay off just a little bit. Let's say you just paid off 10K, for example, from the monthly installments, the capital. So you still have 800K, you paid almost nothing. You didn't even like started to overpay. So here in this example, easily your LTV is 80%, not because you started to overpay the capital part, but because it just like rise up at itself as a valuation of the land, of the district, of the apartment. I'm not saying that it's always like this, but there's a high chance that when you bought something and you're gonna check it right now after years, probably you can swap the offers to way better banks. That's what I'm saying. You can optimize the credit by refinancing. That's the fourth point of the story, that you can from bank A go to bank B. Here I have a mortgage. So bank A, for example, it's here. I have a mortgage in bank A, and then you want to go to bank B. So bank B is not transferring the money like you did before to developer, but he's transferring money straight to bank A. The bank A is closing your mortgage. You don't have any debt there, and you are not paying any interest in advance, any more cost from the like estimated future schedule that you would pay. It's just like done. The mortgage is closed, and right now you are in the bank B. The mortgage is put on your estate from the bank B. It only works if you really go to the better offer, but as you remember, 20% down payment offers are way more profitable for you with lower costs, lower interest. It's just more suitable for your vision, how you want to pay it, very usually. So, making the long story short, you may ask at the very beginning, what if I have only 10% down payment? Can I ask, am I able to apply for the mortgage? Yes, you can, yes, you do. So what's gonna be the difference? You're gonna have slightly more expensive offer if you go only with 10% because it's the higher risk of the bank and it's not recommended by the government institutions. Then you need to consider the pros and cons. If you prefer to rent right now the apartment that you're renting, you're paying for the owner just the rent, and you're never gonna get back this money. And in this time, you're gonna save more and more until you have 20%, or you just want to start right away, go to the bank with slightly more expensive offer with the higher margin rate of the bank, or or having the insurance of the low on contribution, which is gonna be kind of harming you at the very beginning. But then, as you remember, you are not there forever, because the real estate price is gonna, with some drops, they're gonna, let's say, somehow in a long run go upper. So probably the denominator, which is gonna be value of your apartment, is gonna rise up, and then it's gonna rise up. Your nominator is gonna mean less and less comparing to that. So the percentage is gonna be lower and lower. So you're gonna be able, hopefully after a few months or years, that's what they do with our clients, go to bank B to do what? Refinance the credit. It's called refinancing. Of course, you're gonna pay off some capital during this period, but let's say it's irrelevant, this story. If there's any more pros and cons of the of having 10 versus 20%, yes. As you remember, with 20% you have access to all the banks, while the 10% only allow you go to, like, let's say half of them. The timeline was related with just paying the first 5 years of the, the first 5 years. It's related with the paying off the installment with the capital. So the last thing to recall is to speak a little bit about value plus finishing / renovation gives us future value. You remember from the previous video that you always pay this down payment 20+% or 10% from always the future value. So value is gonna be the garage spots, storage, the whole overall price of the apartment, plus if you're finishing from the bank loan or renovating the second market real estate, is gonna be added. If you do it from your own pocket, from your own cash, we are not considering that, so we just pay the down payment from the value. But if you take money in addition to renovate or finish that, we pay the down payment always from the future value. That's it. We went through all of the most important stuff here. Thank you for your attention.